Hello, David Moore, Equity Advantage, here with Robert Smith of Peregrine Private Capital, and we're going to try to answer more questions than we raised today. So first off, you're looking sharp as usual, and here I am, but I do have some really fancy socks.
Those are the coolest socks I've ever seen. Those are nice.
Mermaids on them.
Those are nice.
Good.
Those are nice.
They work.
I envy you your socks, David.
Thank you. Got to have something there,
I know,
right?
you do. You do. Every morning, every day.
Yeah, so we joked about the California T-shirt, the California shirts in the heat, and now we're joking about the socks. But, I got a standard I got to try to keep up with here. So,
Maintain.
But Bob's a wealth of knowledge on all things, actually, just economy-wise. And so I want to start off by just sort of asking you, what's the sort of the state of the market right now? I mean, we're having the interest rates are starting to change a little bit. And what kind of impact do you think that's going to have on things, and what are your clients asking you with respect to that?
Well, I think clearly everyone's major concern now is inflation, and how is that going to impact my investments? And that's a very serious question that all income property owner operators should be asking themselves, because obviously all assets go up as interest rates go down. That process oftentimes reverses itself when interest rates start going back up. And you're already starting to see the stock market register that, the bond market register it, and at some point in time, the real estate market will register it as well. That being said, it's very, very, very important to understand the distinction between the two commercial property types out there available in DST format, operating assets and single tenant net lease assets, and how they are different from an operational standpoint, and how they are ultimately priced differently. Operating assets are all assets or many assets with multiple tenants and short lease intervals, whether it's multifamily, self-storage, senior living, manufactured housing, as opposed to a single tenant net lease asset, Walmart, Walgreens, something with a long-term corporate lease. The fundamental difference between the two asset types is your ability to increase rents. Obviously, operating assets with multiple tenants and short lease intervals, assuming full occupancy, gives the landlord maximum ability to increase rent, or gives the landlord ability to increase rents in as frequent a manner as possible. And we think that's going to be critical to capital preservation in the current inflationary environment, because commercial real estate acts much like bonds. Again, as long as interest rates are going down, the value of your asset will usually go up. But when interest rates start to reverse, if you're not able as a property manager to keep up from a rental standpoint with corresponding rent increases, that may mean that your property is worth less rather than more. And so that's why in this environment, as an income property investor, you should be focusing almost exclusively on operating assets of some type, because they're a better inflation hedge than single-tenant net lease assets that are highly structured with relatively infrequent rent increases, and oftentimes the rent increases aren't substantive. So you're trading flexibility for the perceived security of a long-term corporate lease. And again, when interest rates are going down, that's fine. Interest rates are starting to go back up now. It may not be so fine in the future. And that's going to be critical to maintaining the integrity of invested equity, that ability to increase rents with as great a frequency as possible.
So you're talking about people's ability to increase rent and just to even stay up with the inflationary rates. And I look at rent control, just Multnomah County, for example. We're talking today from Portland, Oregon. So Multnomah County's, the core area, core county for the city here, and we've got very strict rent control there. But it's possible, even with that, the limitations they've got, you could actually be going backwards with your ability to even have the rent increases to cover inflation. And one of the big objections that people have, if we dispel one of the biggest objections I think people have about going to DST, is that they sort of initially resist they've always been hands-on, and all of a sudden they're handing you money to invest for them into assets that are totally passive for them. And so it's a hard thing at first to give that up. But then over time, especially with markets that are very heavily rent controlled, I mean, it's really, you find that a lot of them come back to you and say thank you after a while. They're relieved of those responsibilities and therefore able to sleep a little easier at night?
You're exactly right. The first and most important hurdle most income property owner operators have to get over when transitioning to DST, a more passive investment format, is control. And honestly, if you're not at that point psychologically, emotionally, where you want to give up control, then DST is not appropriate for you. And that's the most important question you should ask yourself. And whomever you are dealing with should ask, do you want to give up control? And once you get over that hurdle, we think it's hugely emancipating, because most income property owners, at least at the retail level, have historically been limited to their local markets, what they can see, touch, and feel. And as you just mentioned, we're in Portland, Oregon, and I believe Oregon is still the only all rent control state in the nation, albeit there are different levels of rent control up and down the West Coast or the left coast. And that's really going to inhibit your ability to keep up with inflation when, whether it's a state government, local government, unilaterally tells you what you can and can't do from a rental standpoint. And we might, year over year, national rents have gone up just over 14%. Obviously, that's not the case in Portland, Seattle, other places, but in the Sun Belt, parts of Florida, Tennessee, Texas, red states, we're seeing tremendous rent increases, which reflect the tremendous pent-up demand for housing coming out of COVID-19. And one of the questions we are often asked is, with multifamily property prices at an all-time low and cash-on-cash returns at multifamily properties at an all-time high and cash flows at an all-time low, is this the end? Is this the top? And we think not, because we think increasing interest rates on the part of the Fed, and the Fed is coming to this very, very late in the game, is actually going to accelerate, or actually may accelerate, rent increases or in that market. Reason being is as interest rates, as the Fed increases interest rates, mortgage interest rates or mortgage rates will increase correspondingly. And as mortgage rates increase, then the single-family home market is going to become even less affordable than it is today. And that's...
Yeah, so as I'm sitting here listening, I was taking notes, and I was going to ask you about the interest rates, and you jumped ahead of me, but that's because he's proactive here. But I was just thinking, it's like instability. So you got inflation, interest rates, and ultimately those two things are going to lead to some instability of the market too, right? Yes. Or it's going to initiate movement from things also.
Yeah.
So I mean, we talked briefly before we got started just about, we were talking about being at the top of the market, and you were sort of giving me your theory on, no, we're not, for a variety of reasons, and one was really the added interest rates are going to make property less affordable, and therefore it's going to put more pressure on a couple of your more popular asset classes in the DST space.
Correct. We think rising interest rates are actually going to increase or accelerate existing rent increases in the multifamily market, for the very reason that it will make single-family housing less affordable than it is now, which will then force more people into the rental market at a time when supply is extremely constrained. And that in turn may very well accelerate rent increases. I think it's particularly true given the fact that you read aloud, or you heard about the supply chain disruption, logistical problems, and and all the ships sitting off the coast that can't offload product into the United States. And the Biden administration's claim to the contrary, it's actually worse now than it was a year ago. They simply took all those ships that are sitting off the coast and moved them over the horizon so you can't see them. And there are now ships backed up from Oakland all the way down to Longview, and New York all the way down to Miami. So much of the materials that you need for new houses, new apartments, are sitting in the middle of the bloody ocean and can't get offloaded. So we don't expect that dynamic to change anytime soon. So we think multifamily is still a very, very attractive asset because you may see a continuing strength in rental increases. So, and again, if rents are increasing 14% on like last year, 14% was the national average in other red state markets like Austin, Texas, parts of Miami, rents increased over 30%. So it's obviously geographically specific, but if you're seeing and you're able to benefit from those types of rent increases moving from a rent control market to a non-rent control market, you're obviously staying ahead of inflation. And that's the most important consideration right now.
So we were talking yesterday, we were talking about the top 3 asset classes in the DST space right now, or at least those with the highest pressure. And you mentioned what?
Self-storage has been the top performing commercial asset type for the last 20 years in terms of total return. And the pandemic simply exacerbated that. Self-storage came out of the pandemic as the pandemic's hot property. And it's because, guess what? With self-storage, you don't have any people. You just have people's junk, okay? And, so you don't have any virus, and junk doesn't vote. So there's no percentage for the political class to stick their long nose into it from a rent control standpoint and or eviction control standpoint. So it's kind of below the radar screen in terms of the political class. And interestingly enough, self-storage doesn't need a good or a bad economy to thrive. It simply needs an economy that's in a state of change or a state of flux, because it's change, people changing their lives, work lives being disrupted, school tenure being changed. It's that change that catalyzes the demand for self-storage. And right now, I believe the national average for self-storage occupancy is about 97%, which should tell us that, or should tell you as a potential investor, that there's not enough of it, and we're probably not charging enough for what we have. And the only downside is institutional buyers, pension funds, the insurance companies, institutional players have been gobbling up self-storage as fast as they can because it was the pandemic's strongest property. And they also see it, and I tie this back into the issue of inflation. They actually see it as the premier inflation hedge in the commercial real estate industry because lease intervals are monthly. So again, assuming you can keep the property fully occupied, you can increase rents in self-storage with greater frequency than any other asset class. There are hedge fund operators that are buying exclusively self-storage properties because they see it, recognize it as the best possible inflation hedge in the commercial real estate environment.
So we look at inflationary hedges. We always talk about tangible assets, obviously, and we hear all the ads for gold and silver, and more silver these days than gold. But I mean, look at platinum's just gone down dramatically, but you're still betting the thing's going to go up in value to make you any money or to preserve your money, where with the real estate, I always like to say it's the ultimate tangible asset. You're not banking on it appreciating. At the end of the day, it will, but for all these other reasons. Now, the other thing I'd sort of talk about the instability, another I mean, anytime the stock market starts stumbling around, our IRA 401k business picks up. And it's just with people being displaced from jobs or voluntarily making changes. And I'm sure you're no different than what I'm seeing in our business. Even one of our radio advertising guys who was, I don't know, not very old. I don't know if he was even 50 years old, decided he was retiring. So, I mean, a lot of this with COVID and everything else, people are just pulling up, and the IRA 401k side of our business gets busier during times of instability because people are losing jobs, choosing to change jobs so they get access to 401k funds they normally wouldn't have access to until they're 59 and a half. But that makes changes. They want to do startups. They want to do other things. But I just think even another buddy of mine that has a big commercial real estate firm sold his house, basically bought a trailer, and he's traveling around the country right now. And so the point is, where's his stuff, right? It's in storage someplace. So I can see, and it's sort of interesting. I mean, you think about your parents, I think about my parents, grew up in wonderful, nice houses, but, we're 2,000 to 3,000 square foot house, maybe 3,200. It was a huge house in those days. And look at all the McMansions today. So I guess I sort of have to look at it and question, you keep buying these bigger houses, and I see, my kids, my youngest is a senior in college, okay, and we're pretty much empty nesters now. Do I need the house that I used to have? Absolutely not. Am I getting tired of paying the property taxes for that house? Yes, I am. If I were to sell it, now my wife, I'm the bad one of the two of us because I can't get rid of stuff, right? I just sort of keep it all. But, so if we were to sell that big house, where am I going to put my stuff, right? So, I mean, so you're seeing a market where you're probably going to have more pressure once again on apartments because people are selling. I've got friends that are moving into apartments. I mean, they've had houses, they don't need the house, and they're just saying, well, gee, why would I have all my capital tied up in that when I can go do other things? So we talk about the top groups of assets in the DST space. I don't see anything but upward movement in all of that with, whether it's doors, multifamily stuff, or the mini storage stuff. I mean, it's all going to continue to increase. I can't imagine that we have people, I mean, just think about the not the economy, but just, the environmental pressures of today's world. I mean, is it PC to go buy your 5,000 to 7,000 square foot house, or are you going to see people maybe going the other direction when they do? What do they do with their stuff?
Partner, that depends whether or not you live in Hollywood.
Yeah.
So, no, I think you're exactly right. And using the I word, instability, I think is an excellent and very, very succinct way to think about the present and the future. If anything's characterized our culture for the last 2 years, it's been instability. And that instability isn't likely to go away. There are long-term changes afoot that may not have necessarily been catalyzed by the pandemic, but were hugely accelerated by the pandemic in terms of long-term lifestyle and work changes. And as you just said, all that change mandates or creates increased demand for self-storage, multifamily, those types of assets that allow people or give people the flexibility to change. So when you're investing in self-storage, or for that matter, multifamily in a red state, you're not just creating an inflation hedge for yourself, you're also investing or banking on long-term lifestyle and work changes that are now in place and are not likely to go away. And, we could expand upon that and make the observation that for the 10 years prior to COVID, the decade or more prior to the pandemic, there was a steady in-migration of people, money, and jobs to urban centers. That's where all the young people wanted to live, so the businesses and the money followed. And prices went up correspondingly, and even before COVID-19, quality of life went down. So again, even prior to the pandemic, we were postulating on our website that we could be at an inflection point where for over a decade, people, money, and business have moved into urban areas. Now things are prohibitively expensive and the quality of life has dropped dramatically. We may start to see a shift the other way to suburban housing and suburban and ex-urban environments. And clearly, COVID-19 was the catalyst or the accelerant for that, because working remotely is now accepted, and it gives people more flexibility to live outside of large urban areas, and clearly money and business and demand for housing will follow. And so if I were trying to make a call in terms of, okay, if I'm going to buy different asset types, where should they be geographically? And I don't think necessarily anymore they should be in downtown core urban areas, because that's not where people and money and business are moving. I would probably look for better valuations in suburban and exurban markets, because those are the markets that are experiencing the big demand from a growth standpoint in terms of housing. And when people are out looking for housing, as you just mentioned, they're not dead yet. Their kids don't want their stuff, so their stuff's got to be stored.
They haven't become angels yet.
And become yeah, angels, yeah. Okay, so I think you're exactly right, is the I word, instability, now characterizes life in the United States from a personal and from an economic standpoint, and I don't think that's going to change anytime soon. And I think you need to focus then on those asset types that do particularly well in that kind of environment.
Interesting. Well, David Moore with Robert Smith of Peregrine Private Capital, and we'll be right back with some more. Thank you.
You didn't even read my story. Good girl, these stars. I can see me straight